Global trade is no longer just about logistics. It is now a war of margins. If you sell physical products to customers in the United States, your profit model is under attack. You might see top-line sales grow while your bank balance continues to shrink. Buying activity among North American manufacturers has hit its lowest level since May of this year. This is not a temporary dip. It is a signal of a fundamental structural change. If you rely on overseas inventory, you are exposed to political volatility like never before. You need to understand why supply chains are contracting even as consumer demand remains relatively steady. The United States government collected over $200 billion in customs duties this fiscal year. That is roughly a 150% increase over the taxes collected the previous year. This money is not coming from foreign governments. It is coming directly from your profit margins. Understanding this landscape is the difference between a bankrupt business and a resilient global brand. This analysis is essential for anyone managing a cross-border supply chain in the current political climate. The current administration is using emergency powers from the 1970s to impose these new levies. This legal strategy relies on the International Emergency Economic Powers Act to bypass standard legislative hurdles. Retailers and manufacturers are awaiting the Supreme Court's ruling on the constitutionality of this strategy. Justices have expressed skepticism, but the timeline for a final decision remains dangerously unclear. Until that ruling arrives, businesses are hedging their bets and delaying major purchasing decisions. This hesitation is visible in the Global Supply Chain Volatility Index, which is currently in negative territory. A reading below zero indicates that North American companies are severely underutilizing their supply chains. This contraction in the United States stands in sharp contrast to the rest of the global market. While American companies pull back, activity in other regions is slowing but holding up much better. This creates a bifurcated reality in which the U.S. market becomes increasingly isolated by its own tax policies. The administration argues that these tariffs will protect American industries and generate significant government revenue. However, the data show that manufacturers are simply reducing orders for parts and raw materials. If you import components to assemble in the United States, your input costs are rising unpredictably. Many business owners assume that tariffs will be rolled back if the Supreme Court rules against them. Betting your entire inventory strategy on a court ruling is a high-risk gamble you should avoid. The government has already collected $64 billion in duties this year, primarily from Chinese goods. That figure represents more than a third of all duties collected by U.S. Customs and Border Protection. This aggressive collection strategy is forcing companies to rethink their entire pricing and inventory logic. If you are a digital nomad, this is where the trade war hits your specific business model. You might think you are safe because you do not have a physical office in the United States. But if your goods cross the U.S. border, you are the one paying the costs of this trade war. The administration recently announced $12 billion in economic assistance to support American farmers. This aid is funded directly by the tariffs that are simultaneously hurting the agricultural export market. It creates a circular economy in which one hand offsets the damage caused by the other. Farmers have made it clear that they need market-based solutions, not temporary federal aid programs. Soybean exports are a prime example of how political decisions can derail established trading relationships. China has historically been the world's biggest buyer of U.S. soybeans, but that demand is shifting. Recent trade escalations led Beijing to halt imports, prompting renegotiation of lower purchasing targets. Even with a deal in place, purchase volumes remain significantly below historical averages. This volatility demonstrates that no industry is immune to the collateral damage of reciprocal tariffs. If you sell into the U.S., you must anticipate sudden regulatory changes that destroy your margins. Let us look at a concrete example of how this impacts a major U.S. retailer like Autozone. Autozone recently reported that revenue grew but profit fell due to tariff costs. Their gross profit margin declined by more than 200 basis points compared to the previous year. This happened despite the company opening 53 new stores and growing its global footprint. The disconnect between rising revenue and falling profit is the defining characteristic of this tariff era. Autozone management explicitly cited continued higher costs due to tariffs as a primary driver of this decline. They also mentioned a non-cash impact from an accounting charge under the LIFO, last in, first out method. This accounting method highlights how rising inventory costs directly reduce reported earnings for tax purposes. If a giant like Autozone is struggling to maintain margins, small businesses face an even steeper hill. You cannot absorb a 3% increase in product cost without raising your prices. Competitors like Advance Auto Parts have already started raising prices to pass these costs to consumers. This leads us to the situation in China, which is adapting in unexpected ways to U.S. pressure. Despite U.S. tariffs, Chinese industrial production has broken records this year across multiple sectors. China is experiencing a phenomenon known as involution, in which intense domestic competition drives prices down. Factories are churning out cars, machinery, and chemicals at a rate that exceeds domestic demand. This oversupply forces Chinese manufacturers to cut prices to sell their goods wherever they can, aggressively. This price war in China creates a unique opportunity for entrepreneurs sourcing goods for non-U.S. markets. While the U.S. raises walls, China is shipping record volumes to Europe, Latin America, and Africa. Chinese exports to Southeast Asia are up 14% as they pivot away from the U.S. Exports to Africa have jumped by more than a quarter, showing a massive realignment of global trade. This means the world is being flooded with affordable manufactured goods, except for the United States. If you operate a global dropshipping business, consider targeting these non-U.S. markets immediately. The cost of goods for delivery to Europe or Latin America is becoming significantly more attractive. Meanwhile, sending those same goods to the United States is becoming increasingly complex and expensive to administer. The U.S. government has also closed the loophole that allowed small packages to enter tariff-free. This regulatory change was explicitly designed to hurt platforms that ship directly to American consumers. Chinese companies like Temu have adapted by shifting their business models and finding new logistics paths. They are proving that low-cost manufacturing can survive even the most aggressive tariff regimes. However, simply moving your supply chain to Vietnam is no longer a guaranteed safety valve. Tariffs on Vietnamese imports are now hovering around 20%, compared with 37% on Chinese imports. The gap is narrowing, and the administration has signaled intentions to target all major trading partners. This strategy of universal tariffs reduces the incentive to shift production entirely out of China. If you face tariffs everywhere, stay where the infrastructure and speed are best. This is why we see a resurgence in manufacturing capacity in China, despite political headwinds. China's trade surplus in manufactured goods is on track to reach $2 trillion. That sum is roughly equal to the annual national income of countries such as Russia or Italy. It suggests that U.S. efforts to weaken China's grip on global supply chains are failing. In fact, these efforts might be counterproductive, as they could force Chinese industries to become even more efficient. So, what does this mean for your specific U.S. LLC or corporate structure right now? First, you must stop calculating your profit using last year's shipping and duty rates. You need to implement a real-time landed cost calculation that accounts for the latest tariff schedules. Second, you should audit the Harmonized System codes you use for your imported products. Misclassifying your goods can lead to retroactive penalties that could wipe out years of profit. If you have been doing this for the last 3 years, you cannot ignore this section. Customs and Border Protection is utilizing new data matching tools to find discrepancies in your filings. Third, consider diversifying your customer base outside the United States to mitigate risk. The data clearly shows that demand in emerging markets is absorbing the excess capacity from China. Selling to these regions allows you to take advantage of low sourcing costs without U.S. duties. Fourth, if you are a U.S. taxpayer, review your inventory accounting methods with a professional. Switching between LIFO and FIFO accounting can have a massive impact on your taxable income. As we saw with Autozone, these accounting adjustments can change your financial picture by millions of dollars. Finally, do not rely on political promises of a liberation day or a tariff rollback. Build your business model to survive the current worst-case scenario of universal reciprocal tariffs. The most successful entrepreneurs are those who adapt to the rules rather than hoping they change. Subscribe to Tax and Borders for weekly breakdowns of U.S. tax, banking, and global structures. Use this as general education, not individual legal or tax advice. Your situation may require a professional,